Welcome back. You're watching The Firm. We've examined the 5,600 crore rupee NSCL scam in different ways on this show. What went wrong, why the FMC could do nothing about it, and whether savvy brokers and investors failed in doing adequate due diligence. But our coverage would be incomplete if we didn't ask this question. Why did the statutory auditors of NSCL not see the writing on the wall? Especially since the forensic audit reveals violations such as inadequate margins, margin limit exemptions, and misutilization of settlement guarantee funds for the exchange's private use. So this week, Paiswini Upadhyay asks experts if NSCL's auditors were asleep on the job.
The Forward Markets Commission came up with a 5,000 crore rupee question. Is Financial Technologies or FTIL, the parent of NSCL, fit and proper to run an exchange? This question was part of the FMC's show cause notice to FTIL on the 4th of October. It was accompanied by some telling observations made by Grant Thornton in its forensic audit of the exchange. Between 2009 and 2013, NSCL granted more than 1,800 margin limit exemptions. NSCL violated its own bylaws by allowing members to increase exposure without sufficient collateral. Case in point, Lotus Refineries defaulted on 198 days between April 2012 and July 2013. In March 2013, NSCL withdrew 236 crore rupees from its settlement fund to finance its own business overdraft account. NSCL provided credit facilities to buyers by way of corporate guarantees. While NSCL claimed to have 2,389 crore rupees worth of stock in 16 warehouses, it actually had stock worth just 358 crore rupees. NSCL's auditor for FY 12-13, Mukesh Shah and Associates, made no mention of these violations in the audit report. It even vouched for the adequacy of physical inventory checks by the management, said there were adequate internal controls, and also said that NSCL did not provide a guarantee for loans taken by others. In September last week, Mukesh Shah withdrew his audit report for the financial year 2012-13, saying it cannot be relied upon anymore. We don't know the reasons cited for this withdrawal. But what we do know is that this 5,600 crore rupees scam at NSCL is not the doing of just 1 year. Experts say that if these violations that find a mention in FMC's show cause notice had been flagged off by the statutory auditor in the previous years, the damage could have been a lot less. For instance, FMC's show cause notice takes note that in his internal audit report for April to September 2011, the internal auditor at that time, Mukesh Shah, had observed that NSCL was carrying out NBFC-like activities. These included funding transactions without an NBFC license. The FMC notice also points out that NSCL engaged in a financing business where a fixed rate of return was guaranteed on paired contracts. The contribution of such contracts to NSCL's turnover grew from 25% in 2010 to 97% in 2013. But this observation found no mention in the audit report prepared by S.V. Gatalia and Associates, NSCL's statutory auditor, in FY 11 and 12.
If you see such a glaring violation, either you force the internal auditor to change his report that you are wrong, which appears not to be the case because FMC report has brought out this thing now, or if you disagree with him, then write that internal auditors feel this way, but we feel this is wrong, or you just accept the internal auditor's report. So, in my opinion, it has been a blatant mistake or violation, the failure of the part of the Gatalia and company not to report this and take into account. And in hindsight, I think they should be regretting that had they done this, probably this would not have reached this stage.
As a statutory auditor, it is my duty, no doubt, to consider the internal auditor's reports. And one important point which you have made out is that the internal auditor, if he points out that some of the activity which the company has carried out are not within the domain or the object of the company, then certainly it is ultra virus activities. As a statutory auditor also, he has to report. he cannot take cognizance of, he cannot ignore the report and don't take cognizance of such reports. Therefore, it becomes responsibility of the statutory auditor. However, if the internal auditor points out so many issues which are not within the normal commercial parlance required to be reported, and there is some extra caution, then the value judgment has to be arrived at by the statutory auditor whether those reports issued by the internal auditors are so material that it will impact my thinking on giving a report saying that it is true and fair. Then yes, I must take cognizance of that.
FMC's show cause notice also points out that NSCL failed to implement adequate risk management to protect itself against the financial liability of its members. For instance, members were allowed to trade without sufficient collateral despite repeated defaults. Margin limits were increased without adequate documentation on the credit history of the members. And there was a lack of data migration facilities even for critical operations. None of this found mention in the auditor's report.
This has a direct impact on the financial. For example, the data migration is not taking place. This is what the FMC has reported. And there are different systems and the softwares were used for preparing some reports, and they don't match with each other. They don't reconcile with each other. Then the auditor's job is manually do it first of all. Satisfy yourself whether this matching takes place properly or not. And in the event they find that the matching is not taking place and there is a genuine issues related to the reconciliation of accounts because of the different systems operating at the same time, then auditor must take cognizance of that event, saying that this is a lack of internal control.
A closer look at NSCL's 2012 financial report indicates that more than 100% of its revenues were blocked in receivables. Proxy advisory firm SES points out that in the 2012 audit report, the figure that appears as advances recoverable was changed to expenses recoverable in 2013. Also, while income is shown as net expenses, these expenses are yet to be recovered.
In this balance sheet of 2011-12, you have said they have put a figure of advance recoverable of about 144 crore. Now, it is a nomenclature which says that the company would have given advance for something. But if you, when you see the next year's balance sheet, you find that this is not advance given, it is expenses recoverable. Now, when you say it is expenses recoverable, it can't be advances, it has to go into sundry debtor. Now, if you put that sundry debtor, bring it to sundry debtor, there are two issues. One, this transaction has not formed part of revenue, it is not under the sale and purchase thing. Secondly, it is recorded as a net. Now, this is a sundry debtor, and if you take other sundry debtor, the total sundry debtor are more than the revenue declared. So, there is something wrong, the auditor did not do their thing properly.
Further, as per the financial report for FY12, around 354 crore rupees is shown as member liability. Against this, only 186 crore rupees was available as cash or cash equivalents, something experts say the statutory auditor should have flagged off.
The statutory auditor at least must take cognizance of the fact that how are you going to meet the liability of the members in case of the liability is likely to be met. So, to meet that liability, whether the 50% of the cash balance or cash equivalent in some other investment, if it is found, then he should be acceptable, because if those amounts could be realizable at any given point in time, for example, bank balance is there X plus the other assets are liquid assets or liquid funds deposits, possibly the auditor should satisfy. But here is a case that where the bank balance is 180 crores and the liability is around 380 crores. So, 200 crore there is a fill in the gap has to be done. How do you bridge that difference of 200 crore? What has happened with the funds? Has it been lent somewhere, given as an advance to somebody, and this is not in the ordinary course of the business ought to have happened? Then auditor must take note of this seriously.
FV Gatalia and Associates sent us an email response saying, The audit of NSCL's financial statements as of and for each of the years ended March 2010, 11 and 12 was conducted in accordance with the auditing standards generally accepted in India. We are bound by a confidentiality agreement with our client and are therefore unable to provide any further comments. It is not our case that SV Gatalia and Associates knowingly failed in their duty as statutory auditors. The issues highlighted and commented upon in this story seem like obvious red flags to us today, maybe because we have the benefit of hindsight. But what this hindsight fails to explain is why even after this Pandora's box has been opened, SV Gatalia and Associates has chosen to not withdraw its audit report. In Mumbai, Paiswini Upadhyay.
And the NSCL saga continues. On that note, I'm going to wrap up this edition of The Firm. Thanks very much for watching. You know how to reach us. We'll be back next week.